Welcome to the Gray Report. I'm your host, Spencer Gray, and if you are a multifamily investor, whether that's an active investor, passive, LP, GP, you're just kind of curious about the whole real estate investing, the whole thought process. Well, this is the one podcast and YouTube show that really was made just for you to kind of give you all the information that you can use to make some really informed investing decisions, which is, it's so critical, especially in the environment that we're in right now. Things are changing so quickly. Typically, real estate, it moves slow, way slower than the stock market, but things have picked up significantly. We want to talk about that. We got cap rates that have risen. You're not going to read about it, but we're going to report on that here today. We also have reports from Newmark, the BLS, Berkadia, NAR, Yardi Matrix, and CoStarApartments.com. You're going to want to watch this whole video. This is crucial information. Let's get into it. Back on the report, we got Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt's the guy who's doing a lot of this research, or at least coordinating a lot of it to bring you all the latest research reports and data every single week. Again, you can find those here on the Gray Report, but also on the Gray Report newsletter. You can find that by going to graycapitalllc.com/newsletter. Make sure you sign up to get all the latest research reports sent straight to your inbox every Thursday morning. But also don't forget to give this video a like. Make sure you're subscribed if you're not, and leave a comment with a question, a suggestion. We usually not only respond to the comments, but we'll feature them and respond directly on the Gray Report. Matt, how you feeling?
It's great.
Awesome.
Warm up. It's hot. It's hot this week.
It's heating up.
Yeah, it's time to start planting grass and gardening. I'm excited for it.
You didn't do a fall seed? You can get grass in the fall?
I grow whenever I can.
That's my point. Those warm days. But not only is the temperature rising, Matt, rents are continuing to rise. We've got inflation. CPI printed yesterday, 8.1, 8.3%?
8.3, yeah.
8.3, which I guess the expectation from the street was 8.1. Okay. Came in a little bit hotter. Yeah. That signals a couple things. One, we're probably going to see more rent growth with more inflation. Yeah. But it also means that the Federal Reserve is going to probably stay true to their path to tightening monetary policy, raising rates. They don't have enough signs that allow them to kind of hold off on that. They're going to kind of keep tightening up until they see something happen with unemployment or the economy. To me, it seems like we're already in a recession, though. I mean, there's blood on the streets in the stock market, public markets. Yep. Real estate, pretty stable. A lot of bubble talk, but we've heard bubble talk for the last 10 years. But one thing that has absolutely happened, and again, you're not going to see it even on these reports, and a lot of people talking about it because a lot of people are in the business, they don't want to talk about it. Brokers, syndicators, whatever. Cap rates have risen. Yeah. 100%. Cap rates have risen. Cap rates have been on a long trend of declining for the last really decade and a half. They've been incredibly low, unsustainable low levels, and that we've talked about this on recent reports, but that cap rate to interest rate spread has inverted, and we haven't really had that invert really ever, especially in some markets. The real big movement, though, is on the kind of the shorter term interest rates, and really that are used to set the interest rates for bridge financing, debt fund financing, those floating rates that could be very, very low, and they were so attractive, and it allowed borrowers to borrow sub 3% with flexible terms that allowed them to really pay up for these assets, even at low cap rates, not producing a lot of cash flow, just because they were going to lock into essentially free money. That party's over. Yeah. So now we're back to reality. Things have to pencil. We're back to fundamentals, which is awesome. I think we're going to see some good buying opportunities.
Yeah, but everyone that has properties, they're going to be sad because the cap rates have gone up.
So if you have a property right now, the cap rate goes up. Unless you're trying to sell right now, how much does it matter?
Yeah, I think that's and we were talking about this beforehand. I think that's one of the reasons why people are holding off on talking about cap rate expansion is because there's a whole audience of people that are going to be kind of bummed out if they hear about cap rates rising.
Yeah.
But on the other hand, like when I hear about that, I hear opportunity.
Yeah.
It's not like rents have stopped growing. It's not like the actual and I think that people use the word fundamentals to mean a lot of different things.
Sure.
But if we're talking about money coming in, money going out, there's a lot of money that these properties are still throwing off. And so if it's cap rate expansion time, then maybe it's good for buyers.
No, I think 100% that's the case. I mean, we've already seen the term soften from like just a hardcore seller's market to now relatively balanced.
Yeah.
The terms are much more reasonable. Again, not many people know or talk about it because there's only so many people that are in the middle of transactions right now or bidding on properties. The terms have gotten a little bit better. It's been really easy. It's been easy the last year or so because it's like prices were going up. Everyone's hitting their strike price or their whisper price, or if not more. There's a lot. There's a lot of volume last year. Everybody did really well. A lot of newer brokers are getting good education right now. I think a lot of individuals, regardless if it's real estate or whatever markets, you're going through an education right now.
Yeah.
There hasn't been a consecutive 5-week decline in the S&P 500 since like 2007, 2008.
Yeah.
So we've gone over a decade without this type of continued downward trend. And we've talked about some tech stocks. I mean, some of the high flyers, like especially like millennials are investing in, like the top stock, it's not millennials, Gen Z, the top stocks that Gen Z is investing in, the least the top stocks have declined is like 50% and like the max is like 90%.
Wow.
Because it's all like the electric car companies, Peloton, the meme stocks, Tesla.
And I mean, crypto, but it's like all of this. And I don't even think it's probably limited to the stock market. It's just that if you're including crypto, it is this idea of the crazy growth investments that we had, last year. And now, they're going back into value investments.
Well, because you're discounting that cash, the future cash flow at a higher rate, and so they're just worth less. And so people are moving into cash flowing or dividend paying investments, with multifamily being a great option, and that's why it's all relative. But I've been having conversations with people saying this is not a reason. This is the reason why we invest in multifamily to begin with, or because of events like this.
And what's interesting too is, and you talked about cap rates and how everyone's nervous about, because cap rates could move maybe right now this week. They're a little bit higher, but I wonder if we're going to get increased demand from investors fleeing the growth stocks into multifamily that might press them back down.
We don't know, but I think that there's quick bump up in cap rates. I don't think they're going to rise up that high because exactly what you said. The fundamentals are still good. There's still a ton of growth there. People still want to get allocated to real assets, multifamily especially. So there's going to be a floor on the pricing. There is a floor, 100%. And cap rates, I think, are going to continue to decline again. But we got to get through this uncertainty right now. And
I'll go into this kind of simplistic view, but it's hard to see a situation where cap rates don't expand a little bit right
They
now.
Have to. And we've been saying that. They have to. Like, you can't have interest rates where they are and not see some lifting in cap rates. And again, it's not like cap rates are blowing out. It's like they're returning to some level of relative normalcy. And a lot of this, there's a big difference, and this is a distinction of some of the high-flying markets in the Sun Belt and markets in the Midwest. In the Sun Belt, that's what you're seeing, the 10% price reductions for sure, because the cap rates were sub 4. In the Midwest, the cap rates weren't really sub 4, maybe 1 or 2 deals. They're all kind of in the mid 4s. But there's less. The higher you climb, the longer you have the fall, and so we just didn't climb that much in the Midwest. That's why we like it, is because it's much more stable and linear trajectory as opposed to these big swoops up and these crashes down.
So you see that actually in the performance of these markets now too.
We'll even see, and I think you're going to get to this, and let's get into the reports now, but I think Phoenix is not having as much rent growth as they saw. So, the cap rates there were crazy, some places in the 2s. Matt, it's exciting.
Yeah, it is an exciting moment. You're right.
It's time to be careful, to be prudent, and that's why we do. Because if we don't have the correct information, best information, we're flying blind.
Yeah.
So we're trying to provide you with a whole dashboard and array of sensors and technology. We've got our radars, GPSs, weather systems, all related to multifamily investing. Capital Markets Report. This is from Newmark.
This may be my favorite report that came across this week. In the newsletter, I said it was an excellent report. I tried to limit my praise a little bit, but I really like the way it covers all the different kinds of commercial real estate, and it compares them along a lot of different lines. But just as a headline, it said that investment volume in commercial real estate increased by 55.6 year over year in the first quarter of 2022, reaching 170.8 billion, which is the largest first quarter volume on record, overtaking the first quarter of 2007, which you just mentioned. So maybe that's prescient. Yeah. Of the 171 billion roughly of investment in commercial real estate, 63 billion was in multifamily, which is definitely the most sought after property type. And dry powder increased slightly to 250 billion, following another all-time record year for capital deployment last year. Higher inflation is expected to favor property types which have shorter lease terms, such as multifamily and self-storage. And I think that it may be this report or another one that talks about hotel performance and how hotel performance actually, when it comes to occupancy, hotels haven't done as well as they expected because of raising airline rates. But the rents have stayed pretty solid actually.
Yeah.
So,
well, just anecdotally, I'd say, yeah, they're definitely up there. And I've heard that, not to get too much into hospitality, but there's a big bifurcation of like destination hospitality hotels and more of your kind of business travel oriented. I think that I believe hearing from Bloomberg that the vacation travel that's kind of back up, at least like 90% of like pre-pandemic levels, but the business travel is still like 60% or so.
Yeah, that makes a lot of sense.
Like, try to go somewhere with a beach. Prices are sky high; they're fully booked. But go to your Cedar Rapids, Iowa. At the new Holiday Inn. Maybe the occupancy may be hitting. You still can get a good deal.
So I'm glad that you paused on these two pairs of graphs here, and because I really liked. We're talking about inflation and rate hikes, and they right off the bat they have a good comparison of these different property types and how impacted they are by either inflation or by rising interest rates. And the most vulnerable, I thought it was kind of interesting, the most vulnerable when you're talking about rising interest rates is student housing, and then healthcare, medical office, and then office buildings, and on down the line. And the least impacted by rising interest rates are single-family rentals, and then real estate, net lease, multifamily. Multifamily's about on the lower end. Multifamily is 5.5% impact. Student housing is 15.5% impact.
Yeah,
so we're on the lower end when it comes to multifamily. And then just to continue the summary, when it comes to inflation impact, the biggest impact on inflation is net lease, followed by office, and then medical office and healthcare. And then and this is expected, we talked about this, the least inflation impact is hospitality, which is at 0%, virtually not impacted at all.
You're, booking room,
the next day.
Selling keys every day.
Yeah. And then self-storage and multifamily is at 0.6% inflation impact compared to the 0 of hospitality, or compared to the 10% of net lease. Multifamily's doing pretty well. Very insulated when it comes to inflation.
And again, back to what we were saying, one of the reasons why we invest in multifamily, you see the Fed printing a bunch of money, the government spending a lot of money. Mm-hmm. Okay, at some point, does that lead to inflation? Wasn't necessarily true the last decade or so, but finally seeing it for this type of event. And by the way, even when we were seeing low rates of inflation, multifamily still performed very well. Mm-hmm. Real estate is a consistent inflation hedge across property types.
So when it this report looks back at CRE returns for all property types and compares them to interest rates really going back to 1979. And for the vast majority of years, the returns for most, if not all, property types beat inflation. Some are beating it a whole lot, and some more than others, obviously. And you can see for the last 2 years, industrial has done
crushed it.
crushed it since 2016.
Yeah.
So that's not any news for anyone that's been following commercial real estate. But also, multifamily is up there as well. There's really, I can't see any year where multifamily hasn't significantly outperformed other CRE property types.
Yeah. Interest rates and cap rates not strongly correlated.
So
true, they're not strongly correlated. Matt and I were looking at this graph, this chart yesterday, and so if you're listening to the podcast, we're looking at some charts, and you can watch all these charts on the YouTube channel, the Great Capital YouTube channel. But we're looking at a chart comparing the 10-year Treasury yield and overall cap rates, and I had a couple issues with this. One, the 10-year Treasury is they have it at 2.32%. It's basically 3% plus or minus today. But we'll forgive them for that. But this is a Q1 report, so that makes sense. Again, but cap rates in general are a lagging indicator because you get the cap rate after it's closed. The purchase price was negotiated maybe 120 days. 90 days.
Yeah.
Prior to that,
you're looking at the past.
You're looking at maybe a good 3 to 6 months. Kind of in arrears, but my gripe with this is good to look at the 10-year Treasury because it's such a benchmark, but I think it would be better to look at a host of other financing rates to really see a better correlation. Just like Noah Stone has mentioned, the kind of the more corporate debt side, corporate bonds are a better proxy to figuring out where cap rates are going. But really, the effect of SOFR and the Fed funds rate and the shorter maturity rates, I think, would show a higher degree of correlation. And I think reading between the lines, not strongly correlated does not mean not correlated.
Yeah, there's still a correlation line here. And it seems like as the interest rate rises, the cap rate rises.
Yeah,
there is
it's not
a pattern to the data. Even the low end, you see a big linear line. So but this is what I was going to say before. It's like it just makes sense, at least on a deal by deal level. Let's say so interest rates rise. That means that the loan that you planned to get for your deal is now going to be not a great loan, and your returns are not going to be as great. And then that goes back, and then you got to go back to your investors, and your investors may say,
yeah,
I don't like this.
Especially
you better
a lot of
change
deals
something.
where it was skinny beforehand. It was low cash flow, and because people are getting beat up in two places. One, on the interest rate, sure, you should have kind of expected to a degree, but even bigger than that is the loan proceeds. Because as your interest rate goes up, it's harder for you to clear the debt service coverage ratio hurdles, and so then all of a sudden they're like, well, not only are we going to give you a higher interest rate, but we're going to give you a smaller loan as well. Now, smaller loan typically lower leverage, but it also reduces returns.
Yeah,
you have to bring more equity to the deal, and so if you were working on a deal that was marginal, you've got a deal that maybe doesn't work anymore.
You go to your investors and you're like, hey, everything's worse. There's a few worse things, and then what are they going to do?
Yeah, well, I think there's a lot of sponsors having to make some hard decisions of like, you better be transparent and open with your investors.
Yes, exactly.
This is what's going on, or what you're doing to, fix it. But if you say, you signed up for this, you signed up for X, but you're going to get Y, and it's a lot worse.
And that's a major
mistake.
Yeah, and these hard decisions and these hard facts really that are moving the calculation of these deals, I think that's why people are going back and negotiating, and why brokers are really earning their money right now is because things have changed, and that change needs to be communicated and adjusted across all these different parties, whether it's the lender or the sponsor or the seller. All these people need to kind of get on the same boat, and there's a lot of negotiating to be done.
And I just recommend, there's a lot in this. There's a 35-page report, a lot of great charts and graphs. Again, I recommend checking this out. Hop on over to grayreport.com, sign up for the newsletter, and you will be able to if you sign up for the newsletter, you're going to get these sent to your inbox every Thursday. Highly, highly recommend it. Matt, we've got an article from CNBC, but it's really, information from the Bureau of Labor Statistics, CPI print. We don't need CNBC Pro. Inflation barreled ahead at 8.3% in April from a year ago, remaining near 40-year highs. I know shelter was a big part of that, moving that number. The core CPI, which excludes food and energy, was also higher than expected at 6.2%. And again, shelter costs, which comprise about 1/3 of the CPI, rose at their fastest pace since 1991. We were kind of expecting that because shelter was really lagging behind a lot of the other price points for a while. Even with all the headlines of rent growth, it was still relatively.
And you know what? If you look at shelter again, it's not like it's rising at crazy speeds right now, and I think there is still room to grow. I think it's also interesting. Inflation adjusted earnings took a big hit, such that worker adjusted income is down 2.6% because wages aren't keeping up with cost of living. Inflation was slightly down from last month, but it's still rising. I think that reduced energy prices a little bit have lifted the core inflation up a little bit more. When you exclude that, it made it grow a little bit faster than inflation as a whole. But it's still going. It's the CNBC article I think was pretty spot on. It's barreling forward. There's not a whole lot of control associated with something that's barreling along. It's not humming along, definitely. And I think that there is a sense of lack of control, and that's one thing I think that the Federal Reserve is going to prick their ears up. Like, well, we can control this. They've got a job to do. They always have a job to do.
But even Jerome Powell admitted, there's a lot of this that is outside of their control.
Yeah.
I mean, they can raise interest rates, reduce demand, they can reduce their balance sheet, but war, and what are they going to do about Russia and Ukraine and natural gas prices because of war going on? What can they do about a baby food shortage for formula because of supplying issues and then a recall? Federal Reserve can't, nor would we want them or the federal government involved in figuring out the supply chain.
And my question too is how long is the lag period between a rise in interest rates and a reduction of demand or reduction of inflation? Because the Fed has been rose interest rates by like 25 basis points earlier this year, and so is that a factor in the CPI? Would it have been bigger if it wasn't for that? I don't know, but it seems like nothing. It seems like a zero effect, and that's what makes me a little bit worried and makes me almost think that the Fed's going to keep pushing this, pushing rates higher.
I think people were living in a little bit of la-la land in 2021. Everyone's making a ton of money in the stock market, crypto, real estate, whatever it is. Everybody's got everybody's got a lot of money, and not everyone's looking at that every day. People are busy with their everyday lives. And so I think, long story short, there's a lot of demand. There's still a lot of demand that you have to destroy to kind of bring that in check. Yeah. And again, some of the pricing is, some of it's inelastic demands, like, the baby formula or, the gas and the commodities or housing. Like, you can't cut back on, giving your baby formula. Yeah. Maybe you can turn your air conditioning off a little bit, but only, you can do that to a degree. So how much, that's the big question. I mean, that's the, whatever $1 trillion question we want to pick of at what is that point where you see enough demand destruction? I mean, the stock market is pricing a lot of that in. That's what we're seeing. I mean, with all these declines. And there are some people saying that the market now has priced in more rate hikes than are really going to happen.
Well, and that's what supposedly there's this the psychological effect of the Fed. You have to believe in the Fed. It's almost like Tinkerbell or something. If you believe that it works, then it kind of works. If you think that the Fed is going to be strict about rising interest rates in an inflationary period, if you trust that they are really going to rein things in going forward, then maybe you do kind of hold off on things. Maybe you do save money instead of spend it. And so that's a big question mark because, heck, I'm not a cult leader. I don't know how to make people believe things.
Yeah. Well, the Federal Reserve's got all the banks, they got believing in them, at least to some degree. But the psychology, you're right, it's so important in where are the minds of investors, where are the minds of banks, and then consumers, because at some point, the price at the pump, the grocery store, that's been hitting people The stock market is also is people are looking at their brokerage accounts and they're like, WTF? What is going on?
Yeah.
Like this is not a like little quick, dip down. We're way past correction. Mm-hmm. We're a couple basis points away from bear market territory. We're almost at 20% down on the S&P 500. I think a day or two ago we were 19%. I'm not a big investor in the stock market. I don't have any reason. I'm not opposed. I like a lot of great strategies in public markets. 100%. I have a concentration in real estate and real assets because that's what I know and that's what I like the best. But I haven't been paying attention to the stock market every single day because of that. But people are hurting. I know this on the Newmark report. They had $250 billion of dry capital ready to go. I know there's investors out there who are nervous because they made a commitment in December, January when they had, their brokerage account was X. Now it's at least 20% less than that if they were just in the index. If they were allocated to some of the, tech stocks, they're down way more.
Yeah, and that's what I wonder, when is this going to, because...
When is the capitulation going to happen?
Yeah, well, when is this going to start to, because the stock market's a little bit isolated in its own world, but it's still connected to real life at a certain point.
Well, and the stock market's a function of psychology and future sentiment and what people think.
But you're seeing a little bit of distance. I'm guessing it's going to start to wane. Things are going to start to kind of run in parallel now. When you see the stock market took a hit, when are jobs going to take a hit? When is wages going to take a hit?
Because it's running. Wages are still rising, but we've started to see tons of tech layoffs because there's just free money of like anybody that had a half-baked idea can get $50 million in runway funding, to come up with their, half-baked, app idea. Everyone was getting fun. That's gone because all the valuations are off. The future growth isn't there, so you don't have the VC money flooding into that space like you were. And even some bigger companies are have already started to laying off thousands of people. Okay. Now the job market's so tight, so those jobs are being absorbed pretty quickly. Mm-hmm. But we've already seen some tech layoffs, and it's what I'm waiting for. And I don't think necessarily we're that far away. Who knows what could happen? But I'm already hearing more and more conversations of going to cash. Big cash position. I'm going to cash. When you start seeing everyone going to cash, that's a moment where it's like, okay, that's people. When people who like are secure in their financial situation, they don't need the money, but they're still going to cash. I think that's a sign that okay, we're probably near a bottom. We're not there yet. And this isn't a show to talk about the stock market. This is just it's investor sentiment across all asset classes because we're not there yet, but I think we are approaching that point.
Okay. Yeah.
So I don't know. We'll see. I'm not going to call it, but I think people can only take so much more of this.
Yeah.
Again, it's week after week after week after
it's
week
spreading
after
for
week.
Sure.
So, all right. So Berkadia put out a little bit of a report here. The national report for the 2022 market at a glance. When did this come out, Matt? Is it
this was just this past week.
This always on top of it. Timely.
This is for Q1. It was actually they had a smaller version of this, kind of like a report card last week, and then this week they released a little bit more of a full assessment of the trends and forecasts for 2022. Their rent growth expectation is 5.9% year over year. I checked their previous forecast from last quarter, and it has not changed. Not gone up, not gone down. I don't think that that's stubbornness. I think that there's a lot of good reasons. It seems like it's a wash anyways. There's a lot of things that you might think could make it go down. A lot of things you might think could push it up.
I think they also just don't know.
Yeah, exactly. Well, when in doubt, don't rock the boat. One thing that I think was nice about this report, and I do remember this actually from last quarter, is they've got a really nice map of inventory growth. I would have loved a full chart breakdown of each specific market, but at least I can eyeball a map and see how much multifamily supply is expected to come online for a given market. They do note the employment trends and sales trends for each year. Definitely, it looks like the employment's going up and unemployment's going down. And that's for now and may change. Sales trends also seems like the price per unit has been increasing, and cap rate, they say, will continue at 4.9%, relatively even.
Yeah, which is a total BS cap rate.
Yeah. It does seem a little different from what we've experienced, but
it's just not. Yeah, that's not correct. It's just. Yeah.
But yeah, when we're talking about inventory growth, I thought this was particularly interesting. And you can see the markets, they have a short list of like the top 12 or so markets. Huntsville is number one with 11.6 of current inventory that's going to be added for 2022. Nashville at 7.1, Austin, Reno, Phoenix, Colorado Springs, Raleigh-Durham, Salt Lake City, Charleston, Boise City. These are all the popular kids.
Yeah.
The popular lunch table. These are all the like kind of the Sun Belt and Western markets that you see that we've seen throughout the last 2.5 years, just growing like gangbusters, and they're adding inventory.
A lot of migration, and it's even been longer than that. But,
and there are current inventory in these, and I think that it's worth, and we've talked about this before, for investors, you want to look for markets with demand and rent growth, but you also want to watch out for a glut of apartment supply coming online because it could dilute the demand. This isn't always the case, and I think that in many, perhaps even most places, they're building apartments as fast as they can. They still won't be able to meet demand. But it's definitely worth a full examination when you see a lot of apartments being built in a market you're looking to invest in, and kind of measure how much of the renter population is going to grow, and if the supply is outpacing the growth of renter population, then that could be a little bit of a risk for you.
I don't know if anybody does this, and I mean we look at it, but I don't think we put it on one graph of just it correlating on two different axes, inventory growth and rent growth. Yeah. Or you could also do like rent growth.
The next chart shows rent growth, and I think this is actually
So they've combined these two charts. And so if you're listening to the podcast, we're looking at this map of the U.S. It's kind of color coded of inventory growth in a lot of markets, and then color coded for rent growth.
So another thing worth noting is there are a lot of Midwestern markets now. They're not the hot ones necessarily for rent growth, not as hot as Salt Lake City or Boise or Atlanta, but those are the ones. These places like Chicago, Cleveland, Memphis, St. Louis, Indianapolis, they're among the many Midwestern markets with significantly less apartment supply coming online. So yeah, they're growing at a healthy rate. They're growing, 7 to 10%, let's say, in a lot of these markets like Indianapolis or West Michigan. But they're not getting the crazy 10% supply added or 7% supply added. So that's just that's a big factor. I think you got to look at both sides of the coin when you're looking for a higher performing asset. So
moving on over to the report from the National Association of Realtors, NAR Commercial Market Insights, April 2022. Matt, bring us in.
Yeah, I follow this every month. NAR comes out with a great report. Maybe not as good as Newmark had a whole quarter. They got NAR puts out these every month, and they showcase and kind of compare the different property types from retail, office, multifamily, and industrial, measure them against each other and figure out, where each one is going.
Can I stop you, Matt? Do you think that they are doing these monthly reports at a detriment to the quality?
Perhaps.
If you are a listener of the Great Report, we very rarely kind of call out these reports, but I think it's important to do so because there's some errors in this report. Just straight up. Some data says one thing, then the actual text says something a little bit different. So, National Association of Realtors, we love the work that you guys do, but probably double check what you're putting out there. So
they're going to block my IP address now.
Yeah, but we're going to put a grain of salt on it. No, they do great stuff. We watch their reports, but specifically, and I don't mean to kind of beat you to the punch, Matt. But in a paragraph, they essentially say the B and C class apartments. Rents are rising fastest in class B and C buildings, faster in B and C buildings than in class A buildings. It is an indication of the desire for more affordable units. Oh, okay. That's different from what I heard. I've heard more growth in A-class units and B than C right now. They didn't even read their own headline, Matt, when they were writing it. I don't know. I don't know. But multifamily rents in class A and B buildings rising at double-digit pace. Okay. That makes more sense.
So the top line summary said that B and C was rising faster. This section says that A and B were rising. And I just thought it was interesting too, because they had a claim. They're like, oh, B and C rising. That means that people want more affordable things. So it wasn't a typo. It was someone got the wrong idea.
And I wonder if that's it's got to be related to wage growth.
Exactly.
Because I think the occupancy in Class C is there, but I think that people don't necessarily have that much more. They can only afford that much more in rent.
If I'm not mistaken, Yardi Matrix looks at the occupancy rates for these things, and the occupancy for Class C is quite high.
Yeah.
I also agree with the Class A and B. We talked about this before. It might be associated with just the amount of space that a Class A and Class B apartment might have over one from Class C. There's a lot of reasons, especially maybe homeowners that are holding off, that have a lot of money that they've saved up, or just a lot of money that they make now. Mm-hmm. They're going into an apartment that has more space and that may be a little bit nicer.
I do think that because of the tight occupancy, I think that you're going to see Class C rents kind of catching up a little bit. Probably not catching up all the way, but we're going to see some pickup there. But certainly, just reading off this growth for year-over-year percent change in asking rents. And so these are like market rents, what we're asking you to pay, not what everyone is necessarily paying. Mm-hmm. As of the second quarter, this is as of April. Across the board, it's 9.4% year over year. Class A, we're right at 10% on the dot. Class B is 10.2%. So really kind of B class assets, the rent growth is outpacing marginally. Class C, though, 7.7%, still strong, still almost 2.5 times normal rate of growth.
Yep.
But not as much as that kind of the 10%.
Another quick thing that I just wanted to note, this is a little bit more broad than multifamily specifically, but it also talked about the job gains for specific markets. And I do want to note, because our home base is Indianapolis, and Indianapolis is up near the top of the markets for job gains, and it's near the top for retail rent growth as well. I know these aren't specifically multifamily numbers, but when you're looking at a market, seeing the evidence of broad-based economic growth in the local economy is, I think that points towards higher demand for housing down the line, and ultimately, redounds to the benefit of the multifamily market.
Well, and that's what's so tough right now is that you've got a strong very strong underlying economy. Actually, the problem is that it's too strong.
Yeah.
And we have to do something because it's too strong and things are getting out of whack in terms of, pricing. But a lot of our favorite metros, Matt, are on this list, including Indianapolis, kind of right there in the middle for very strong net job gains.
We've seen that. There's another report that's that we'll see this in shortly. I think that we're seeing almost like a reversion to the mean when it comes to the rent performance of places like Phoenix. You mentioned this; these high flying rents. Maybe they're not. Maybe they're not flying through the stratosphere or through space. Yeah. But they're definitely still in the clouds. I think that they're coming down though. They're cooling off slightly, and you're seeing the other ones that may have been overlooked continue to have strong performance. Yeah. And so that's bumping them up when you're comparing all these different markets.
Did not get all the way to the moon.
That's right.
Okay, so let's move on over to Yardi Matrix National Multifamily Report. So for this is for what is it? April 2022. So again, as high frequency as real estate wants to be on a monthly basis. What's the headline? Slowdown in multifamily rents?
Yeah.
Not yet.
I like that kind of helped characterize my approach to really the newsletter this week. Is there's a striking stability in multifamily performance throughout this quarter. Mm-hmm. So much volatility in the stock market, and it's not as if multifamily has always been 100% stable. It's been remarkably stable in the pandemic, but there's definitely been times when there's been a bumpy economy and there's been a bumpy multifamily market. In this case, not really at all. Now that it could happen down the line, but I've been very pleasantly surprised, to be completely honest, with the stellar performance of the multifamily market in this quarter. Not anxietingly, not like crazy high performance that makes me think like, oh, are the good times ever going to end? Like, this is just solid, strong, predictable performance that all of the reports are on the line. They all agree that this is what we're seeing right now in the multifamily market.
Yeah, again, the quote is, despite the U.S. economy's recent hiccups, multifamily performance continues to be stellar, and maybe different from some of the other reports, but. Yardi, they're not selling real estate. Mm-hmm. They're more of a data company. I mean, they're obviously their bread and butter is the property management software. So, I mean, obviously they want apartments to do well, but their bottom line doesn't really matter. I mean, they want apartment operators to do well so they can obviously use their software, but it's not like a brokerage firm that is directly incentivized from prices of apartments going higher. Yeah. So, again, I don't think that influence necessarily seeps into some of those reports from brokerages, but just something you want to be aware of who is writing this report and do they have any incentives, even if they're kind of subliminal and they're not. They're trying to be maybe neutral, but they can't help themselves.
Yeah, that's a good point. And I think that's something we should signal to. This is kind of the source and what they're coming from, what their perspective is.
Yeah.
I did think it was. They talked about how year-over-year growth for the multifamily market is at 14.3%. For April, which is a half of a percentage point lower than last month's numbers, but still pretty high, obviously. I think that's going to still continue to come down. It's because of this lag effect and the base effect. You can't just keep building growth after growth after growth. We're seeing healthy growth now, and just because the rate of that growth goes down doesn't mean that we're really in trouble.
So and then again comparing, and we've done this before, Matt, but comparing the different year-over-year rent growth from different sources. Yep. We just saw the NAR report, and we're looking at rent growth, and now we're looking at the Yardi report. NAR had about 10% year-over-year, compared to Yardi's 14%. Again, that could be a difference of what their sources are. Yardi's getting it plugged in from larger institutional property managers. Yardi is not a cheap property management software. It's not the cheapest, so it's going to be larger institutional, professionally managed firms. Whereas NAR may be more broad-based and have more mom and pop operators that they're kind of tracking. Yeah. I don't know all of their sources for their rent growth, other than them just saying that they're their own reports. And again, they kind of flubbed up on the which class is doing well or not. I mean, a lot of this I think is just Bureau of Labor Statistics. I just want to look at the source real quick. Multifamily rent growth. I mean, do they NAR analysis of CoStar data? CoStar data. Okay, so they're using CoStar data. That's interesting. And Yardi. So in CoStar, that's definitely good data.
We got a report from them just in a second here. So
but the Yardis, they're providing all their own data. So CoStar versus Yardi, that'd be a good debate. So. Let's just move on over to the CoStar report, Matt. Unless there's more on the Yardi report, it's good. There's a lot of good stuff in here.
Hit again. It's telling the same story that we heard in multiple other reports here. The Sun Belts are going a little bit less hot than maybe like places in the Midwest, especially if you're looking at month-over-month rent growth. Boston is taking the top spot for month-over-month. Hardly a market for the sun and the surf. Philly's not close behind, along with New York, Kansas City, and Indianapolis among the top markets. Granted, Raleigh, Tampa, Orlando, they're still in there, but this is not the uniform picture of Palm Tree metro hotspots that we saw even a few months ago. So it's not hard to imagine the markets that have experienced the most recent growth being the outliers again when it turns out that 2022 is not the same as 2021. So it's not like a tall poppy syndrome. It's more just like they're falling out. They're outliers now, and I think that there is starting to push up against a hard limit that people have when it comes to cost of living.
Yeah. There are some just straight up universal truths out there that kind of relate to physics and things. There are cycles. There's positives and negatives. And we ebb and flow between those 2 points. And if you don't believe there's some kind of cycles and periods of cycles and subcycles and metacycles, that's just not how the general universe works. And so to think that there's a period of time where, and economics is linked to all that. And so to think that we maybe have been in a period of time where we're just kind of decoupled from the laws of physics and reality and the structure of the universe, that's a little bit of a hopeful. I mean, that's like an extreme and out there analogy, but it's economics actually does exist.
Yeah. And that's why last year when I was like, it keeps going up. It keeps going up.
Maybe it'll just go up forever. Like we're going to be at negative cap rates.
Yeah. So, and this is the part that I wanted to highlight about occupancy. So you see really renter by necessity. The occupancy is higher than the overall renter. So that kind of runs counter to the lack of rent growth in C-class properties. Yeah. And to your point, I think that we will see some rent growth in C-class property, considering the fact that the occupancy is so much.
I personally think we're going to see tightening across the spectrum. We may have more. If we go into a recession, there'll be maybe more, at least volatility in terms of move outs. You may have some more evictions, but I think occupancy is going to be up. So I think our economic occupancy is still going to be either kind of flat from where it was, maybe even a little bit tighter.
Yep.
But the two, I think, are going to offset each other a little bit. Now you have some more. It can be more expensive in those environments that can decrease performance, but it's more related to like turn costs of, so, if you have people moving out, they lost a job, they're going to move out or rents have risen. So they're going to move from a B class to a C class. Well, instead of them staying, now you got to spend money to turn that unit, to paint it, maybe to replace the carpet or whatever you have to do, fix it up. So there's some costs that are associated with that volatility in move-ins and move-outs that typically increases, retention rate goes down during a recession. But the higher occupancy, instead of it being at 93, 94, 95, maybe you're 95, 96, 97. So your economic occupancy may offset that a little bit.
Yeah.
And then you also have the slightly more affluent renters, but then maybe they can't afford that A-class apartment. They're moving down to the B-class. They're still getting a discount compared to what they were paying. So it's just a reshuffling, and there's a little bit of just inefficiency and bleed off in that.
That makes sense.
Move around. Yeah. Okay, so CoStar report. This is the last report. If you've appreciated kind of what we've been talking about what's going on in the market right now, getting these reports not only delivered to you but broken down, please, it means a lot to us. It helps the channel get out to more people. That helps get this information into the hands of investors. If you could like the video, give us a subscribe and a comment, tell your friends about it. Again, that means a lot to us. If you leave a comment, if it's a good question or comment, we're going to feature you on the Gray Report. We've done it multiple times. It's a lot of fun.
That's right.
We appreciate you taking the time. But anyway, so let's look at this CoStar report. It's the last report on the Gray Report.
So this isn't a full. This is a press release more than a full report. So sorry.
No, you're good. It's fine. But national year-over-year national year-over-year multifamily rent growth at 10.6, down from 11.4% in March. Okay, so a little maybe deceleration. To, if you can call 10% rent growth a deceleration. And so now, okay, I'm thinking about all these, the metrics we've seen. We've seen 10% over NAR that was apparently using CoStar data. 10.6%. So no, the national was 9% on the NAR data. Okay, so we got, this is a different metric, but we had 9% according to CoStar. According to NAR, we have Yardi at 14%, but then the CoStar itself says they're 10.6. So
it must be more recent, maybe than if it's
CoStar, maybe it's a little bit more updated data, but just interesting the differences.
Yep, I think that one thing that popped out right now, and one of the parts that they highlight actually again is this changing landscape of multifamily performance this year. And they said all of them at the month-over-month level, the top 10, and we're looking at the year-over-year rent growth right now, but I think that there is a chart or a list of month-over-month rent growth. When you're looking at that, this is recording recent changes in rents, not necessarily the change compared to last year. At the month-over-month level, the top 10 performing markets are dispersed across the country, a stark contrast compared to the Sun Belt market concentration seen in the year-over-year rent growth metrics. I think that if this trend continues, and if we see further reduction in average rent growth, that reduction could be driven by the fact that rent growth, again, this is my spaceship analogy, the fact that these rent growth rocket ships in the West and Sun Belt are cooling off. These markets still are crazy sky-high rent growth, but it's no longer in outer space. We're not, like you said, we're not in the moon. Maybe the clouds
they're in retrograde. They're in a retrograde burn.
That's right. A decaying orbit.
Yeah, they're in a decaying orbit. Hit the retrograde rockets.
That's right.
Played some Kerbal.
That's nice.
Kerbal back in the day.
Yeah.
Fascinating reports. Again, we want to be looking at a wide variety of reports, different sources, different types of information. maybe different incentives. We're trying to break it down from you as neutral as possible. Again, Great Capital, we're a multifamily investment collective, private equity firm, whatever you want to call us. Real multifamily syndicator. We're raising money from accredited investors to allocate into these large multifamily apartments. But we're putting our money into these deals in a significant amount, and the only thing we want to do is do the right deals for our investors.
Yeah.
And so we have to be making very prudent decisions in real time, and there's very little room for error. So again, why we started this, doing the Gray Report, is like we need all the information to make these decisions. Then we decided, could it be a service? Could we be sharing that? Why not? Why don't we make just a more informed market, a little bit more efficient market, which we like the inefficiencies, but maybe that's okay. We'll spread the wealth a little bit. Again, so make sure you've given us a like, help spread the word about the Gray Report. Share this video. If you're watching on YouTube, drop it into your LinkedIn and say these guys have no idea what they're talking about, or take a listen. It's up to you. We like the back and forth. Really appreciate you watching this. Matt, any closing comments?
No, I don't have anything. I've got a lot to think about already. I think this week was pretty spectacular when it came to the information and the changes that we're going to see. So just buckle in, because that's not going to stop anytime soon.
Yep, buckle in, strap in, let's do it. Okay, guys, thanks. We'll catch you on the next episode of The Gray Report.